Hello, welcome to TRDR.tv. This is episode 3 of Stock Market Trading 101. Today I'm going to be doing a little bit of talking about some trading vocabulary. And so one of the things that I recommend is definitely if you don't know what something means, or if you come across a word that you're unsure of, it's important to just look it up on Investopedia or on a couple different websites on the internet, just so that you have a better idea of what you're doing, and so that way you can invest more intelligently. So first of all, what I'm going to talk about would be indexes or indices and ETFs. So first of all, let's go to the S&P 500. So this is an example of an index, and basically what this includes is it's basically a basket of 500 big companies within the U.S. Like I think Walmart and McDonald's are examples of those companies. And what this actually does is, if you invest, if you buy a share of S&P 500, that's actually going to get you invested into all 500 of those companies. So this is a good way to diversify, especially when you're starting. There's more than just the S&P 500, but this is just a good example of how to diversify very quickly and easily when you're just beginning. As you can see, this was a nice choice to do, to buy after 2009. It's a good percentage there. And then similar to an index would be an ETF, which is an exchange traded fund. So let's go, for example, to the Vanguard ETF. So this is a popular one for people that are just beginning. It's similar to the index. I believe it's a basket. Let's see here. It says here the Vanguard Total Stock Market ETF is an exchange-traded share class of Vanguard, which employs a passive management or indices investment approach to track the performance of the MSCI US Broad Market Index. So yeah, this represents a huge market capitalization of the entire U.S. market. So it's a good idea just this is a good way to diversify basically when you're first starting out. And so the difference between an ETF and an index is that ETFs are more easily traded. For example, I think that you can short them, and they also have higher liquidity than the indices. So these are good ways to start investing and to get some diversity when you're really just beginning to trade on the stock market. And then we'll move on to derivatives. So an example of a derivative that's probably that you've probably heard of before is an option. So let's just go to a company here. And so an example, there's two different types of options that I'm going to explain today, basically. One of them being so a call versus a put. And so what a call is basically it's the ability to buy an asset at a strike price on or before a specific date. So say, for example, that I was going to buy a put option for Soon Edison. I would buy a put option if I expected the price to go up. So what that would mean is, say for example here on December 8th, I decided to buy an option for Soon. Basically what that would do is I'm buying a contract, and it's an agreement. It's basically, for me as the buyer, I have the option to buy a share of Soon Edison at the strike price, which is an agreed upon price, on or before a specific date. So say for example that specific date is a month from now, so it's January 8th, and the strike price is let's say 450. So the original price that I was thinking, or that I bought the option is here 330, and the strike price is, let's say, 440. So basically, once it gets past this strike price, then I can exercise my option, and I can buy the share price now at that strike price. So even if it goes up a little bit more, I can still buy it at that strike price, which is nice. So that's a good way to make sure that if you think that the price is going to go up, you're not necessarily forced to exercise that option. Like, say it never gets to this point, then you're not forced to exercise the option, and all that you lose is the cost of the premium, which is usually I don't know, like in between 1% and 5%. I think. I'm not really sure exactly how they determine that price, to be perfectly honest. And then so the opposite of that would be a call option. And so call options is a put option. And so the opposite of that basically is it's a contract to sell an asset at the strike price on or before a certain date. So say, for example, I invested in Soon here, and what I wanted to do is I wanted to hedge my investment because I wasn't really sure if it was going to keep going up or if it was going to drop down. So let's say I bought a couple shares here of Soon, and I wanted to hedge my investment. And basically, hedging just means that you're almost taking out like a sort of insurance policy. It's decreasing the amount of risk that you have on your investment. So say, for example, I bought the put calls here right at the same time that I bought my shares. And so what I'm going to do is I'm going to say in the put calls, I'm going to make the agreement that I want to sell. So I bought here at 972. Let's say the strike price is 9 or 9. So basically, what I can do now is, since I bought those options, the put options, what that's going to allow me to do is, since the price drops down here, luckily I bought those options, which gives me the option to sell at that strike price. So when I invested in the company, I originally thought it was going to go up, and then what I would do is I would just let those options kind of go null and void, and I would just lose the premium. But since the price actually dropped down to about here, to about 282, I don't want to have to sell my shares for 282. So I'm going to exercise my put option and sell them here for $9 a share, which was the strike price that we agreed on before in the option. So that's a good way to make sure that you kind of have a little bit of insurance, which is also called hedging. And so there's a couple other examples of derivatives, and those are basically swaps, which are a little bit complicated and not really going to get into today. Futures and forward contracts. So futures and forward contracts are similar to each other, but futures are marked to market, and forward contracts are not marked to market. So futures can basically be traded. It's a specific amount, commodity, and delivery date. Whereas a forward contract can be customized because it's actually a contract that is not traded on a centralized exchange. Anyway, both of those can sometimes be used for hedging as well. It's usually most of the time for hedging with Forex, I believe, with the foreign exchange. Like, for example, if you run a business and you are unsure of basically what's going to happen in a couple months with the foreign exchange amounts, you can buy a forward contract, and that is going to give you a set exchange rate at that forward date. And so that way you can know exactly what you're going to be able to exchange the amount of money for. So say, for example, I do some business, I'm living in the US, I do some business with Europe. They're going to send me euros, 1,000 euros in 3 months. I'm not sure what the exchange rate's going to be, and I don't want to be totally screwed if something really happens and the dollar tanks. So what I'm going to do is I'm going to take that forward contract, which is going to allow me to hedge my my exchange risks, and so that gives me the amount that I'm sure that I'm going to get in the future. So the last piece of the last vocabulary word that I guess I'm going to go for today is shorting. And so shorting is basically the opposite of investing. So here, if, say for example, let's stick with Soon for right now. If I thought at this point the stock was going to go down, which it did, I would attempt to short the stock. And what that is it's a contract to borrow an asset and then sell and then cover later, basically. So basically, let me show you what that is. So say for example, I want to short the stock here, which means that I'm going to buy a contract which allows me to borrow somebody else's share. And that share is usually borrowed, I believe, from money markets or mutual funds or something along those lines. Anyways, so what that's going to happen is I'm going to buy the contract, which allows me to borrow a share from one of the money markets. I'm going to sell the share up here, and then later on, so say for example the short contract is for a month. Later on November 7th, I have to basically cover my investment, which means that I have to buy back the share that I sold up here. So say for example, yeah, you sold the share here at 972, and then you're forced to buy it back here at 740. Well, you ended up making a little bit of money. You made almost, you made over $2 on the share, and then you're forced to buy back or cover because you are forced to give back the share to the person that you borrowed. But you made a little bit of money because you were right. You shorted it and it went down. So that's basically how you do shorting, and that is going to be our show for today. Keep using TRDR.tv, and I hope that you enjoyed the show for today. Good luck with trading.